Hello, everybody, and happy Tuesday. Stephen Meade with you with Domicile real estate for people who love houses. Just a couple of things before we start. There is a link down below to our home searching app. This is actually our own app. It's not something you have to enter in a code. You can actually find it right in the App Store. We've got a link down below. We don't hit you with ads, and you won't have your data shared. So yay for that. Definitely check that out. So is this the beginning of the end or the end of the beginning for our market here in Southern California? And I say this because we've seen a couple of indicators sort of change directions this week. There's talk of a recession. We mentioned this in our first time buyer episode last Friday. So if you didn't catch that, you might want to check that out. But the Federal Reserve Bank of Dallas came out with an interesting article about home prices nationally and what they think is going on. So I definitely check out our take in that other video. You can find that on YouTube if you're watching this on YouTube. I think it's our last video before this one. So we've got some things that are changing. And when you're a buyer or seller in the marketplace, you obviously want to know how are these things going to affect you and your strategy. We've seen rates really head up the last couple of months. I mean, relatively quickly. And that's something we've always talked about not being a good thing, right? Is that rate increases over a long period of time are fine, but rate increases really quickly over a short period of time are a lot more shocking to the market. So let's go ahead and dive in, and we're going to weave in this conversation about what we think is going on and what you can do about it. So starting off here, let's take a look. So starting off at our total active listings. So this number is heading up, but it's really, this is pretty slow. And if you add these two together, we are still not at the level we were at this point last year. So as far as inventory goes, we are still behind inventory. And I'm a big believer in that you've got to have inventory to have a reducing price market. If you don't have much inventory, your chances of prices dropping are not very good. So that's number one thing to kind of look at here. If you look at our new listings, right, this is kind of just holding steady in this range. Yes, there's a little bit more in that 1 to 2 million range in last year. Again, I think this is actually just these sub-$1 million houses getting more expensive. But even if you add these two together, we're still not at that level of new listings coming on the market as we were last year. This should hardly be surprising to you, right? The big reason is a lot of these move-up buyers that have been in the market or were in the market last year when rates were low, that move-up opportunity for those buyers, for those sellers is gone. So they're not going to put their house up on the market just yet. Now, this is the one that I'm finding kind of fascinating, right? And this is our level of new escrows, which is yes, it's slightly more than it was last year in our 1 to 2 million category, but look at how much things have dropped since last year in our under 1 million. So if you added these together, the number of new escrows is significantly less. Now, again, because the market is already tracking out with new inventory, it means that our supply-demand relationship isn't changing very much. But take note of this, right? That we've got a situation where we do have, and it makes sense, right? If the same home in terms of payment cost significantly less last year, there would be fewer buyers today, right, in the marketplace. The problem that we have is that even with these changes, which are reducing our absorption rate here, we are still well above this 70% threshold, right? And we're not really that far off where we were at this point last year. So that demand and supply balance isn't really changing. So yes, there are fewer buyers in the marketplace, but sadly, there are also fewer sellers in the marketplace. So it's not making that market seem that much easier as it once was. That could change, right? If the number of buyers precipitously falls very quickly, for example, if rates became 10%, I would expect that the number of buyers would be greatly reduced in the marketplace. If we look at kind of our prices, remember this is taking a look in that rearview mirror, 4 to 6 weeks. If you look back here since the beginning of the years when we saw this kind of run up in prices, I think prices are going to level out through the summer. This is not uncommon in our market. I haven't said this in a while, and I feel like I have to repeat this because I think it is really important to remember. When people say home prices are going to go up 12% this year, that's not, I mean, I think Zillow might be saying that, but I don't know whether that's true or not. That does not mean that home prices go up 1% per month. That is not how it works. I don't think we've ever had a year where it looked like that. Instead, we see things like, oh, March and April were really big months, or in this case, I would argue that January, February part of March, or the latter half of January through the middle part of March were really big price increase months for us this year, where we get a lot of those gains in a short period of time. Then the market levels out. Then it jumps up a little bit more towards, that early fall period seems to be a big period in our Southern California market. So understand that it's pretty normal to see that the slope of price increases change over the year. Like, our market is not just one constant simple flow. It doesn't work that way. So jumping back in here and bearing that in mind, yes, we had some pretty strong price increases at the beginning of this year. I don't think it's possible for that pace to continue. I think with rising interest rates, we're going to see that these are going to look like smaller increases for the rest of the year. I think that's kind of around where the general consensus is among other economists. I think flat, small increases. Now, if we look at our percent still active after 14 days, this is our second indicator, right, where we're talking about how competitive is that market. And we see both of these numbers are shooting up. And what does that mean? It means that tendency for properties to go instantly is being reduced. And I think what we're seeing in this market is, before there was such a shortage of supply that every single house went under a contract within 7 days, or almost every single house. I don't think that's the case anymore. I think we're finding the good houses are still getting 5 offers on them. They're going under contract quickly. Overpriced houses, maybe the scratch and dent houses, back to railroad tracks, etc. Those homes, especially if they're overpriced a little bit, they're taking a little bit longer. And that's why we're seeing this percent still active after 14 days jump up. That's why we're seeing that market go up. Now, in the grand scheme of things, look where this number is. Is that really totally out of line or out of range? Not really, given where we've been at the past, especially through that August time period last year, July and August. These are not outlandish numbers, but they are going up, and I think we should take notice of that. Now's another one that's kind of another piece of information that says maybe those winds are shifting a little bit. Our close to list ratio, right? I mean, these are still very high elevated levels, right? We've kind of plateaued here around 104% for our under 1 million, and we're at 107%, but that actually spiked and then kind of came back down a little bit. So pay attention to this, because this tells you a lot about how the expectations of sellers and the expectations of buyers are aligned. And I think we might be in a situation coming up where, honestly, some sellers might be a little bit greedy and thinking that the market has moved at a pace for the last 30 days that it hasn't. And now we have our days on market, right? So this is what I love about the statistic, and what makes this different than our percent still active is what this looks at is this looks at the homes that actually are in escrow, right? Percent still active is looking at the homes that didn't go under contract, right? The ones that came to the market that didn't go into escrow. This is looking at all the homes that went into escrow. How long were they around? These numbers are still very, very small, meaning those attractive houses are still selling quickly, likely with multiple bids on them. But that differential between these two stats says to me that our market is stratifying. And what that means is, it's not a homogenized market. There was a joke maybe about, I don't know, a few months ago, that you could put an outhouse and a porta potty in your driveway, slap a for sale sign on it, and you'll get multiple offers, right? I don't think that's the case anymore. Before, the great houses got 30 offers and the crummy houses got 10. Now the great houses get 5 offers on them, still great for them. The crummy houses get 1, and the sellers might not like it, try for something better. So I think we're seeing that stratification of the market start to occur. So if you are a value-minded buyer, this is good news for you, because it means that not everything is going to be an insane bidding war. You might be able to find homes that are not insane bidding wars. Moving on here to our affordability. So This, if you missed our little episode for first-time homebuyers last Friday, this is really what we went over, like what was really important to us. And that was this idea, and what the Fed was talking about is this notion of sort of the difference between where they think home prices should be and where they actually are. Now, we do things a little bit differently over here, and I personally think we do them a little bit better. What instead I think we're looking at is we're looking at the payment on a median priced home, indexing that back to June of 2018 versus CPI as an index. So if you can look here, right, pretty much all from about March of 2021 to probably about the end of November, these were in line, right? Home prices and inflation were pretty well in line. Then things started to move upward a little bit, and then they just shot through the roof here. And right now we are at, our index is at 138%. You'll notice our CPI index line does not extend here. That's because our March data actually does not come out until April 12th. That's when the Bureau of Labor Statistics actually releases that information from the federal government. So on hopefully by our next update, we will have March filled in with this line so you can get a little bit more data. And what's interesting is we did another little analysis last Friday, and that was we looked at rents on entry-level homes, and we kind of compared that. And if you look at that, at least at the entry level, it turns out that rents have out-accelerated inflation. This is hardly shocking. But I think that's a far more important statistic when we're trying to understand our home prices themselves overvalued. But do understand that with these big interest rate increases, and I mean, honestly, they really aren't that big, but they're big compared to where we've been. That's going to change some of the budgeting and some of the affordability. And I think we are starting to see those effects in our market. Unfortunately, it means we've gone from a red hot market or a white hot market to a red hot market. And I don't know if that's really that much different. Looking at our prevailing mortgage rates, here we are shooting up towards this. I think we might be missing our last piece of data in here, but I think they've leveled out mostly for the last week. So I think kind of in this 4.5, just over 4.5 type numbers where we are. You know, I really hope to see these interest rates level out a bit, because I know, especially for our first-time home buyers out there, it is hard to watch your buying power erode, even if prices are not increasing at quite the pace they were a month or two ago. At the same time, I think there is a little bit of welcome relief, right? This market that we are in right now feels a little bit more normal than we've seen, maybe even in the last year. And I think that, you know, I've always said that a healthy market is really better for buyers and sellers. Kind of the crazy circus market isn't great. So I like that the interest rates have brought a little touch of sanity to our market and our negotiations, but I am honestly a little bit disappointed, you know, to see that buying power is eroded. So hopefully what we're going to see is these interest rates take a little bit of a pause, kind of level out, and let the market catch up and adjust to them. So thank you so much for watching. Questions, comments, we love them. Do not forget to like, subscribe, and hit that notification button. We will see you on Thursday for our architectural video. We've got a big surprise. We're kind of launching something that I think a lot of our architectural lovers are going to love, especially if you're into attainable architecture, which is something that we really like to focus on. You know, I can post up pictures and do videos on $4 million houses all day long. They're beautiful. But I think we've had a lot of clamoring for people who want something that feels a little bit more attainable than that. So stay tuned for that announcement. Obviously, if you are looking to buy or sell real estate in Southern California, namely Los Angeles and Orange counties, we would absolutely love to work with you. Definitely don't hesitate to reach out, and we will see you again real soon.